Great. All right. Welcome, everybody, to another LFI Lunch and Learn. Today, we have the team from Trion Properties here joining us. Andrew and Max, appreciate you guys coming on and sharing some information with our community.
Thanks for having
Yeah,
us.
thank you, Chad. We appreciate it.
Absolutely. Yeah. Oh, go ahead.
So my name's Andrew Lucas. I'm gonna kick off the presentation, and then I'm gonna hand it over to Max Sharkansky, our managing partner. And yeah, we're excited to do this lunch and learn. We purposely wanted to do a lunch and learn, not pitch a specific deal, because this is our first time interacting with left field investors. We've heard great things. We have relationships with multiple investment groups with somewhat similar, somewhat different profiles than left field investors, but it seems like you guys are pretty unique, and we're happy to be here and introduce ourselves. So I'm going to go through and give you guys a little.
Sorry, Andrew, one real quick housekeeping, just to let people know. We'll do Q&A at the end. If you have questions along the way, please dump them in the Q&A section on Zoom, and we'll get to those at the end. But sorry, Andrew, I want to get the one housekeeping thing out of the way and then let you guys go crazy with it.
Great. Yeah, thanks, Chad. And yeah, just to piggyback off that, we obviously put this presentation together, but in doing these many times over, we do find that a lot of the value does come from the Q&A. So please ask all and every question that you can think of, and we'll do our best to answer everything. So again, I'm Andrew Lucas. I head our capital raising and investor relations platform at Trion Properties. We have a very diverse investor base. It ranges from individuals. Everybody has to be an accredited investor, but ranging from individuals investing as little as $50,000 up to foreign and domestic institutions that have invested $50 million plus. So I think we are somewhat unique in that regard, that we do have an institutional platform, but we also offer high net worth investors the ability to passively invest in an institutional quality portfolio. And then shortly, again, I'll be handing it over to Max Sharkansky. He is a co-founder of Trion. They started this firm in 2005, so almost going on 20 years now. And we built a great business and bought some great real estate as well. So just a little kind of background on Trion. Again, we were founded in 2005. We're closing on a 471 unit deal next week in Texas, in Lancaster, Texas. So that'll take us over 900 units and over $2 billion. We've acquired, I believe it's 86 deals in total. And to date, we've had 52 exits. So we've round tripped 52 deals. And on those 52 exits, we have achieved investor level returns, IRRs, of over 30%. So we have a pretty robust track record of performing well in good economic times and in bad economic times. So, we're not a group that started 5 years ago and has only operated in a rising tide. We've demonstrated the ability to perform well in good times and in bad times. And we solely focus on multifamily properties. And we do buy deals with different profiles, but the vast majority of our deals fall into that value add bucket. And really, so we're trying to buy properties with good bones, oftentimes built in the 90s or good quality 80s construction. And we like to try to find well-located properties, but buildings that are being underutilized. So we'll acquire these assets, we'll make them more desirable places to live through renovations, interior and exterior, very hands-on management. And ultimately, we're able to push rents a couple $100 a month. And we're also vertically integrated, so we're able to control expenses. And so that combination of increased top line income and controlling expenses allows us to push the net operating income higher. And as you guys know, the value of an apartment building's really just a function of how much income it generates. So if we can increase that NOI 1.5x or close to there over a 3 to 5 year period, that typically works out very well for us and our investors. So I did mention one of the things that somewhat distinguishes us is we are vertically integrated. We believe in insourcing as opposed to outsourcing. So on all of the properties we own on site, there are Trion employees managing the property, leasing the property. The maintenance technicians are Trion Properties. And Texas West, they're supported by our LA office. And then east of Texas, they're supported by our Miami corporate office. And I mentioned previously that, while we do accept high net worth money, we do have a very institutional pedigree. So here's just some slides, some logos of some of the institution and family offices that we have worked with. One of the reasons why we're very excited to present to left field investors, and why we've continuously put emphasis on growing our high net worth investor base over the years, are for times like we're in right now. So right now, the majority of US-based institutions are not investing. They're that high interest rate environment, economic headwinds. By and large, they are all on the sidelines. However, our high net worth investors are still investing. Basically, in our experience, if you're investing your own money, you're still allocating money. Whereas if you're investing other people's money, you're likely on the sidelines. So this to us creates a unique opportunity. We have, in our company's past, capitalized in times when there is a lack of buyer pool in the market. We did this during the Great Recession. We did it during COVID, and we want to do it again right now. Like, we're buying a 471 unit deal for 117,000 a unit next week. A year ago, that wouldn't even have been possible, because all of the companies on this slide and hundreds of others would have been chasing that deal. But right now, everyone's on the sidelines, and that creates a unique opportunity for nimble sponsors like us to go in and capitalize and use the leverage that you now have as a buyer in the marketplace. So this is just, real estate is cyclical. So I wanted to break down kind of our track record throughout different cycles. So from 2005 to 2009, 7 acquisitions, 6 exits, 35 IRR on the exits. And then we got out of, we had very fortuitous timing. We put everything onto the market in late 2008, early 2009. So we got out prior to this crash. Then moving to 2010, 2012, that was a period where there was a lot of dislocation in the market, as everyone can remember. So we capitalized on that. We were well positioned from our successful exits. And we had a huge downturn, 12 acquisitions, 9 exits, 51 IRR on those exits. And then 2013 to 2019, we went back to value add multifamily once that distressed market cleared, and again had success. And then an interesting time was March of 2020. Come January, February of 2020, we had a lot of trouble competing on deals. Every deal was getting bid up, 30, 40 offers on every asset. Then, so we had trouble acquiring assets, in late 2019, early 2020. Then COVID hit, and it felt kind of eerily similar to right now. There was just not a lot of buyers in the marketplace. Everybody was what the industry called pencils down, and we were one of the only few groups out there aggressively writing offers. And if you were a seller and you're in a position where you didn't have to sell, you just hold on to your asset. But if you were in a position where it was a forced sale, you needed to meet the market, if you were aggressively writing offers, you were able to pick up great value. So we've historically capitalized very well when there is a lack of buyers in the marketplace, and no one has a crystal ball, but it feels like we're in a similar situation right now. And what I wanted to highlight this slide. So clearly values have corrected a bit in since 2021, 2022, but we bought about $600 million of assets just in 2022 and 23. Every one of these deals, and things could change, but as we sit today, even though the market's come down, we're confident every one of these acquisitions, will hit its targeted returns, because we never got into underwriting super low cap exits, double-digit rent growth, or even high single-digit rent growth. So because we were disciplined in our underwriting, and we were able to source deals off market and avoid the competitive bidding scenario, even though the market was hot, our 2022 acquisitions should be just fine. So, we have a demonstrated history of being able to transact on the acquisition front and the disposition front throughout all market conditions. And then here's just a look at our dispositions for the last 2 years. Again, even though markets are down, we've been able to have some very successful exits. We've averaged a 27 IRR and a 2.0 2.04 multiple on our recent dispositions. And then here are we've got a couple deals on the market. The Cole should do very well. Grayson should do very well. Park 88 will do okay. It's in the Bay Area. It's in Fremont, California. So, I'm sure you guys follow the headlines. The Bay Area hasn't quite come back like other parts of the country. So before I hand it over to Max, one thing I do want to kind of just emphasize is, our current opportunity, and Max will go over a slide, is our fourth fund. We're currently accepting investments on our fourth fund. We will be accepting commitments through, I believe it's November of 2024, and we'll be allocating money over about the next 24 months. And nobody has a crystal ball. I unfortunately don't have a crystal ball either, but we are in a new real estate cycle, and values have corrected. And again, we can't guarantee the future, but historically, multifamily values do not come down very often. And when they do, it tends to be a very good buying opportunity. Historically, if you buy in the first couple years of a new real estate cycle, it tends to work out very well. So we're very excited about the vintage of our fourth fund, as we'll be allocating money over the next 24 months. And it feels like, we have the possibility of allocating it during the trough of the market, where there's a lot of room for it to run up. So with that, I'm going to turn it over to Max. He's going to talk about the economic, the kind of the macroeconomic environment, where we're currently seeing opportunities. He's probably the most knowledgeable multifamily investor I've ever met. So take advantage, ask any questions that you have, and feel free to pick our brains.
Thanks, Andrew. That's very kind. Next slide. So the interest rates are clearly the elephant in the room. It's what everybody wants to talk about. That's the driving force in the current cycle. This is a inflation interest rate driven cycle, money printing / interest rate driven cycle. And it's driving the current bear market. And once we get back into a rate cut cycle and we get back to the neutral rate of what the Fed has signaled between 2.5% to 3%, or between 2 and 3%, we'll be back into a stable, more normalized market. And what we see here is the current SOFR curve. The SOFR curve is where futures markets today, this is maybe a couple days old, where futures markets believe rates are going. Personally, I'm not a big believer in this. They're pretty consistently wrong. There's a chart, actually, unfortunately, we didn't use it for this seminar, but we can email it to Chad and he can send it to all you folks. There's a great chart that shows the SOFR curve and where rates actually went, and just historically, and how wrong it's been. But this is, again, if you want something to lean on, this is where futures markets thinks rates are going. Personally, I think we'll probably get rate cuts at around that time. I do think it's correct. I don't think that the multi-trillion-dollar commercial real estate market will be able to withstand rates this high for so long. I do think inflation is largely behind us, so I think we'll be into a steeper rate cut cycle by the end of 2024, and rates will be below 4.5% before the end of 2024. So we should start to see bond rallies at that point, and a lot of mortgages are based on bonds, not just on SOFR. So we'll start to see some improvement and normalization of the market the back half of next year. Next slide. The multifamily business, from an unlevered business, is still a phenomenal business from a fundamental perspective. We dabbled a little bit in office and retail during the GFC. Just give you a little bit more color on us. We started buying in 05, 06. We built a portfolio. We were fortunate to have good timing in 08, and we sold almost our entire portfolio. And we changed our business model from buying value-add multifamily to buying non-performing debt secured by multifamily, as well as multifamily foreclosures. And we did that in 9, 10, 11, and 12. And then in 12, as the distress on multifamily cleared the market, we started dabbling a little bit in retail and office. And, as you could see, now office is just a dud. Retail was in a down market for about 8 to 10 years. It's really doing well right now, and it's had a good comeback, but it took a long time to cycle down. Multifamily, on the other hand, you still have a huge supply-demand imbalance in the US. Occupancies have barely gone down. They have gone down, but let's say from 96, 97 at the peak about a year and a half ago to maybe 93, 92 right now, still doing phenomenally well. And there's a lot of catching up to do with new supply to bring the equilibrium and balance in the US, and it's probably not going to happen, specifically because interest rates are so high. Developers can't really get anything new out of the ground. So we'll have deliveries in 2024 as starts from 2021 and 2022 complete. But come 25 and 26, we'll have almost no new supply, and the supply-demand imbalance will continue to go out of whack, and we'll have really strong rent growth moving forward. Next slide, please. So a little bit more background on us. We started the office in LA in 2005-06. We started buying, and in 2020, we made the decision to enter the Southeast. I moved to Miami in 2021, and we made our first hires in early 21. And we've been buying in the Southeast ever since. So now we have 2 offices. Our LA office covers California, Oregon, Colorado, and Dallas, Texas. And our Miami office covers Florida, Georgia, and the Carolinas. So we're pretty well geographically diversified. We're in 8 states and 13 markets. Next slide, please. This is part of the reason why we diversified more. When we made the decision, almost our entire portfolio, other than 1 property, was in California and Oregon, which are very politically risky. And we started to grow into Colorado, and then I moved to Miami and opened an office to cover the Southeast. And as you can see here, Florida, the Carolinas, Georgia, just huge in migration. And we want to be here to be a part of that growth. Next slide. So right now we have an open fund. It's Fund 4. That deal in Dallas that we're buying is also open. We have a little bit of money left. A little bit of allocation left, but it's largely subscribed. But yeah, we've got Fund 4 and a couple bucks left in the Dallas deal. Let's get into Q&A.
Great.
It looks
Thanks,
like we have...
guys. Yeah. So again, people that are tagged on listening in today, please feel free to dump questions in the Q&A for the guys, and we'll be happy to cover those. Yeah, Andrew, I don't know if you want to read off as they come in. You're more than welcome.
Looks like we got 1 question so far. On slide 6, you showed more acquisitions than exits. What happened to the properties that were not sold? We're holding them. We currently have, I believe it's 30 properties in portfolio. We're not typically a long-term holder. We usually underwrite for 3 to 5 years. But then if it's accretive, a classic example, like the deal we're buying in Texas, there's a bunch of industrial development there. We're planning on holding it 3 years. If in a year from now, Amazon announces they're building a huge logistics center next door, we'd likely hold it longer just because that would clearly be accretive to the property. So we usually underwrite to about a 3 to 5 year hold with the flexibility that, if somebody makes us an offer we can't refuse after year 2, we can flip out of it. Or if there's a compelling situation, we're very bullish on the market, then we could potentially hold it longer and just cash flow the asset until we exit.
Can you do 1031 exchanges? If somebody has a meaningful exchange, usually $1 million or higher, then we'll allow them to exchange into an acquisition.
And one thing we kind of touched on this, but we didn't explicitly say, we offer the ability to invest via the fund structure or into direct deals. So, some real estate by nature tends to be a deal by deal business. And many of our investors like to go directly into specific assets. And then conversely, we have a lot of investors that like the idea of being spread over a pool of 15 to 20 different properties in diverse geographic locations, just because it's naturally going to be a lower risk investment. So we offer the ability to invest directly or via the fund, which spreads you over a pool of assets. How long is the seed investor opportunity be available? So the way we structure our funds, there is a trade-off between investing early and investing later in the fund. And that trade-off is, if you invest later into the fund, you will not have to wait as long to start receiving distributions. Fund 4 will likely start distributing probably Q1 2025 or Q4 2024. And we'll be accepting commitments until November of 2024. So if you invest right before we close it, you don't have to wait as long to receive a distribution than you do if you invest right now. So to offset that, we give seed investors better economics. So if you invest in the first $20 million of the fund, you get a higher preferred return and an extra 2% of the distributable cash flow. So a seed investor receives a 10% pref, and if you invest less than 250, 76% of the cash flow. If you're an ordinary investor, so after 20 million, that would be an 8 pref and 74% of the cash flow. Here, I'll go back to that slide as well. So yeah, feel free to reach out if you want any more clarity on that.
That's the definition of a seed investor versus an original or ordinary investor, is just the timing being part of the first tranche, if you will, up to a certain threshold.
Correct. And yeah, we're currently at about 8 million. We do have a Japanese investor that'll likely be coming in for $5 to $6 million in the coming weeks, but there still is, we still have some room before we get to 20. Max, you want to take this one? Can you give some examples?
I'll take the next few. Okay. Question is, I think I heard your fund will be open until late 2024, but you also said you're almost fully subscribed. Please clarify. No, the fund will be open until late 2024. What's almost fully subscribed is the deal that we're buying in Dallas. It closes in a couple of weeks. We have a little bit of allocation left, but not much. And if it doesn't fill up, then we'll just use the fund to close the gap. And that deal closes September 27th. I'm sorry, September 27th. Andrew, if you'd like, maybe we could share the PPM on it. Can you give some examples of your value add strategy? Yeah, sure, no problem. So we go in, it depends on the asset that we're value adding, but if it's a blank canvas value add play, that, an asset that hasn't been touched in 10 plus years, then we'll go in, we'll do a full common area reset. We'll paint the property, we'll do the signage, we'll do the leasing office, we'll reactivate some of the amenity space. Like we'll take an old rec room that's unused, we'll turn it into a fitness center. We'll add, we'll try to find some empty grass and turn it into a dog park, because so many people in this day and age have pets. And then on the interiors of the units, we're typically spending $15,000 to $20,000 a unit. We're doing plank flooring, new fixtures, stone countertops, painting the kitchen cabinets, doing the doors, vanities in the bathrooms, new faucets, and we're really going A to Z. Is the new Texas deal underwritten for 3 years? Yes, it is. Will the fund have properties in the states that you mentioned are more politically risky? Example, California? Yes, but less so. As of right now, the only 2 assets are in Colorado and Texas. It might, if it's a 20 property fund, it might have a couple in California.
And one thing
Go ahead.
Really the only market we're targeting right now in California is Sacramento. So we're not going to be buying rent controlled properties in the Bay Area or Los Angeles. Sacramento while it's the state capital, it actually tends to be a little more politically moderate than the coastal markets. And then the market in Oregon, where we are most active, have been the most active, is in the Tigard and Beaverton suburbs. So about 20, 30 minutes west of downtown Portland. So there's a lot of negative headlines coming out of Portland recently, but the first ring suburbs have actually been a benefit, just because a lot of people are trying to get out of the urban core and move to the suburbs due to the blight that's occurring in Portland. So yes, there is political risk there, but we're kind of very strategic about where we do invest in California and in Oregon.
For the fund, the amount that we commit, do we wire the entire committed amount up front, or will parts of it be called upon as you acquire assets in the fund? Good question. It is structured as a cash call fund. However, if we're very busy with several acquisitions, then we'll call all the capital.
So because we're buying Riverbend next week, if you wanted to commit to the fund, we could accept your capital in full immediately. But once we close Riverbend, that would not be the case, because we don't have an acquisition right behind it that's imminently going to close.
Do you accept IRA money? I know you don't want to give tax advice, but I'm trying to learn about UDFI, and I understand the depreciation is calculated differently for IRA investors. Will you please clarify, do you report depreciation on K1s differently for IRAs? I think you're referring to UBTI, maybe. But yes, we do report depreciation. You would have to consult with your accountant. I don't know how that all works. It's really case to case. But yes, we do accept IRA money. I just don't know exactly about UBTI.
We have over 100 people that have invested through IRAs, my father included, with Trion. And I know there is we always have to say there is a possibility of UBTI. I personally have never received a complaint or correspondence from an investor saying that they've been adversely affected. That said, talk to a tax professional. I know there is the possibility of UBTI, but with over 100 IRA investors, it's never been brought to my attention.
Is the Colorado Springs property in Fund 4? No, it is not. That we've owned those for a couple of years. That's in Fund 2.
So yeah, Fund 4 currently has 3 investments. It has a preferred equity investment in a property in Charleston. Then it has an investment in Portland, Oregon. And then we got a really good buy on property. I believe it's 198 units in Aurora, Colorado, so Denver. And then this Riverbend property will be the 4th acquisition. And ultimately, the acquisitions pipeline, unfortunately, is it's a little slower than it had been in years past. But our 2nd and 3rd funds each had 18 investments, so we're targeting 15 to 20 multifamily investments in the Western and Sunbelt states.
Is the fund itself underwritten for 3 years? No. If so, doesn't that juice the returns? Wouldn't it be more conservative to underwrite for at least 5 years? We do both, depending on the debt. Sometimes we do 3, sometimes we do 5. Our typical, so over the last 10 years, our average hold period has been 39 months. That said, a lot of the times we like to underwrite for 3 years because the reality is we're holding it for 3 years. What is your debt strategy for the fund? Bridge, fixed, etc. Debt strategy is on a case-by-case basis. If the property has enough NOI in place, we'll go get agency debt. Oftentimes fixed. The property that we bought in Colorado has fixed rate debt. The property that we're buying right now in Dallas has fixed rate debt. Dallas is 3 + 1 + 1. So it's a 3-year loan with 2 1-year extensions. The Colorado loan is a 5-year loan. We try not to do too much long-term fixed rate debt because getting out of it can be very expensive and kill your returns. On your map, you have a star for Washington. I've never seen a syndicator targeting Washington. Seattle in particular is unfriendly for landlords. Please comment. We don't own in Seattle. We've been trying to buy there forever. Yes, they've had some issues, especially through COVID, but it's still a fantastic market with Microsoft in Seattle and all of the tech in Seattle. So it's a great place to own. Phenomenal economic drivers. What do you anticipate the cash return to be when it starts in late 24, early 25? You know, everything kind of starts out with a 3 to 4 or 5% cash on cash return. Then as we sell properties, you know, hopefully those are a 20 plus project level and you get mid to high teens investor level. And that's, you know, and then at some point you get to a 5, 6, 7% cash on cash. And as we get later into the fund, we sell more properties in the high teens, low 20s, which equate to a mid to high teen investor level return. What would your typical cash flow be early in the fund? Typically 3 to 5% early in the, well, typically it's close to zero because we're doing all the renovations. Right now we're getting a little bit more cash flow because of what's going on in the market. So call it 3, 4% early in the fund, and then that just goes up.
And with the fund waterfall, your accrued, the fund 4 waterfall is number 1, return of capital. Number 2, investor preferred return. 3, manager catch up. 4, profit split. So you're always earning, if you invest now, you're a seed investor, you're always accruing a 10% preferred return on your unreturned capital.
Have you had any assets whose performance did not meet pro forma? And if so, could you please elaborate on what went wrong? Yeah, sure. There are plenty. I mean, it's hard to paint it with a broad brushstroke, but sometimes you have a cost overrun. Sometimes you have a macro event like COVID and political issues in California and Oregon. There's a macro event right now. We're literally in the middle of a macro event and in a downturn. So we're selling a couple assets, but we're doing fine on them. You know, we're just, you know, we feel like we're doing well enough to return capital to investors with a decent return. So yeah, there's all kinds of different issues that happen.
We've never had an investor lose $1 in a multifamily deal in 86 deals. So, you know, yeah, as Max said, things can get thrown at you, but we've got a perfect track record for multifamily.
I'm in Colorado. What is the name of the Aurora property?
Trail Point on the High Line.
Trail Point is the one that we just bought. And then we also own Felix Apartments. So if you look it up, it's the Felix Apartments. It's about 400 units. Trail Point's approximately 200 units. Is refi after 2 to 3 years part of your model? It's not in the model, so it's not artificially juicing returns, but we oftentimes refinance. So we get rid of the bridge debt and refinance hopefully into something a little bit less expensive and cash people out. Most splits are round numbers. Why are yours structured this way? I'm assuming you mean for Fund 4. We do it that way so that we create incentives for people to invest more. We'll take a lower promote for people to invest more money. So those are the levels where we break them up.
The non-traditional splits, just to make sure people are paying attention.
Yep.
I like it.
And then here's all of our contact information. Feel free to reach out to me. Max, Mitch is Trion, Max's co-founder at Trion. And yeah, oh shoot, let me
a lot of good fire there in the questions. I love seeing that come in from the group, so thank them for that. But any things that you kind of generally get in your frequently asked questions that maybe we didn't get highlighted? Specifically thinking of, you know, our community is made up of limited partner investors. So from the investor side, anything that maybe didn't cut up, I know this wasn't a deal webinar, so it wasn't specific to the fund and you were trying to give us your usual pitch you would for that, but are there general topics that limited partner investors might be interested in that we didn't ask that would be worth bringing up too?
Yeah, one point to touch on actually is that we do use a third-party fund administrator. So we purposely outsourced the fund accounting to a very reputable third-party administrator named Verivest. So they're the ones that are calculating the waterfall. They're the ones calculating the preferred return. So we purposely created an arm's length there. And then in addition to that, we also get third-party audits on every deal that the fund invests in from Armanino LLP. So they actually come in and look at the books, look at the finances. So Max can't take a private jet to Paris with his wife and run the expense through the property. So we purposely created a system of checks and balances to essentially make us Madoff proof. There's still investment risk. A deal could go bad, but we purposely structured the fund, to basically ensure that it's Madoff proof. And so even if you invest not in the fund but a direct deal, our fund will be investing in that deal. So those financial statements will be audited. So any deal that the fund invests in needs to have audited financial statements. Yeah, other than that, sometimes people ask me, what sets you. There's plenty of good syndicators. There's plenty of bad syndicators too, but there are other good syndicators out there. And so people ask, what sets you guys apart or what makes you unique? There's a couple things in my opinion. The first is how much skin in the game Max and Mitch and our employees have in Trion's funds and deals. Max and Mitch have, almost their entire net worth invested in Trion's operating company and the assets that we own. And then, myself, some of our senior people have a significant amount of our own net worth invested with Trion. And then in addition to that, we've lowered our minimums for Trion employees. So we have about 150 people, I believe, in total. At the corporate office, about 40 of us. And last time I checked, I think 25 of the 40 people in the corporate office had either themselves or their families' money invested in either Trion's funds or Trion's deals. So, that kind of helps create a culture of accountability, and a feeling that we're all rowing the boat in the same direction with our investors. And then the second point that I think makes us somewhat unique is we've been at this for almost 20 years. We've bought almost $2 billion in real estate, 52 successful exits. So we're not the new kids on the block. We've demonstrated the ability to perform well in good economic times and in bad economic times, but we're still young. I'm 41. Max, whose birthday is actually today. How old are you, Max? 44?
Yeah, today I turned 44.
Happy birthday, Max.
Thank you very much. Thank you very much.
So where I was going with that is while we've got this 20-year track record, we're in our early 40s. Max and I and a lot of the guys and girls have young children. So we're going to be working for a long time. So our goal in doing these webinars and growing our investor base, it's never to try to sell somebody to invest. It's to hopefully build a decades-long relationship where we can mutually build wealth together. So yeah, that's
great.
We
did have one more question pop up in there too, Andrew. It was asking about cost segregation and what could be, do you guys do it? What could be expected for year one if you guys have a kind of average?
Let me answer that one. Yes, we do cost segregation. As you may know, the rules are, it's now escalating down. The bonus depreciation is escalating down every year. You can no longer take full expensing of the 5-year life in year one. So, what was 40 to 50% of your investment in year one is now maybe more like 20 to 40. And then next year will probably be more like, 15 to 30, somewhere in there, depending on the deal.
Okay. Yep. We're all trying to figure out the new math on that, see what the impacts will be and everything else too. So
there's an election though next year. And I think the general thought, and then the tax package is expiring following that election. So there is some thinking that expensing can come back in 2025, which would mean that you can then again expense your 5-year life in year one.
Very good. So it looks like the questions have dried up now, which is fine. Your contact information is right here. People, please feel free to reach out and connect with Andrew or Max if you have other questions or want to get to know them more. Again, the Lunch and Learns are built to introduce an operator to the group, just to let you meet them and see what they're about. Hopefully, if there's some interest, you guys will reach out and talk to these guys more about what you're interested in. But Max, Andrew, appreciate you guys both coming on today and sharing your information.
Thanks everybody for your time, Chad. We appreciate the opportunity. We're looking forward to being in touch.
Absolutely. Very good. All right. Thanks, everybody.
Thanks everyone. Bye-bye. Good to meet everyone.